Your bank deposit is literally a rigged commercial loan. Martin North, John Adams. In the interest of people. Hello, John.
Hello, sir.
Right, good to see you once again. And we're going to go really deeply into a really, really important subject today.
Yes. So last week I was in Adelaide. Everyone knows that I work for a gold and silver dealership. So I actually had a bit of an event last Thursday in Adelaide, and we had about 120 people there at the event. 90% of the audience actually watched this show. So a lot of our audience was there to come and listen to me talk about Armageddon and a few other sort of key topics. And so there was a question that I asked the audience, and to be honest, only one person out of 120 got the right answer, and that sort of concerned me to say, because what we're about to talk about today in terms of bank deposits, the point we're going to make today about deposits are a loan to the bank. This is something that you and I have discussed on previous shows, but perhaps it hasn't got through to the audience, because obviously a lot of people who I saw on Thursday night in Adelaide, they didn't fully appreciate the point. So the purpose of today's episode is we're going to give some context around this key definitional issue that when you put money in the bank as a bank deposit, you are a unsecured creditor, and you technically and legally have given a loan to the bank. So that is the key message of today's show, because I think a lot of Australians don't think in those terms.
No, John, the urban myth is that you are effectively giving your money to the bank for them to look after on your behalf, right? And they'll pay you a bit of interest. And any time you want the money back, you can just go knock on the door and say, give me my money back. That's the urban myth, right? The reality is completely different.
So let's just go through this, what happened in terms of Adelaide. So as we're getting into this conversation about bail-in, I asked the audience, I asked, as of today, who has given someone a loan? 30% of people put their hand up. And so I said, well, okay, without naming names, who was that person? Was it a work colleague, a friend, a family member, a sibling? And so everyone basically said, they said a sibling, a sister, a brother, a cousin, children. Children was a big answer that was come up, and only one person said Westpac. So only one person actually understood that by putting money in the bank that they have actually given Westpac a loan. So that is obviously quite important. So the Old English view is still the understanding of a lot of Australians, and there has been a shift in documentation and thinking within the banks, but particularly legally in the context of terms and conditions. And so this is a critical point that Australians need to understand, because of all the financial risks and the systemic risks that we talk about when it comes to the economy.
Yeah, I don't think it's just in the banks. I think it's the banking system, right? So if you look carefully at things like G20, if you look at things like the more recent work that's been done internationally in terms of rescuing banks when they get into distress, right? There's been a big change in the wind. And it's been, I think, driven dramatically since the GFC, right? So we've got a banking system that's morphed and a re-emphasis on deposits as an unsecured loan. That's what's happened.
Yep. Excellent. So where I want to go to now, Martin, is so I'm going to go through a couple of definitions. So the first one is just a classic definition that I did a Google search that comes up in terms of the Old English view of what a deposit is. Quote, usually defined to be a naked bailment of goods to be kept for the bailer without reward and to be returned when he shall require it. So that's the traditional view of a deposit. And it's fair to say, Martin, that when you studied banking in the 1990s in London, this is how you were taught a deposit to be.
Yeah, so a bank basically was somebody who took care of your money, or indeed in some cases physical goods as well, in a safe deposit box. They look after it for you and you get it back when you wanted it back.
So we have seen that there were some early references pre-GFC in terms of a bank deposit being a loan to a bank, that you are an unsecured creditor. But in terms of the Australian context, so I actually found a publication published by the RBA in their December quarter 2011 bulletin, where they actually make this crystal clear. So I just want to bring this up at the screen. So this is written by Grant Turner, who was an RBA official back then in 2011, and this is the quote: "The principal mechanism for depositor protection has historically been the preferred status granted to Australian depositors over other unsecured creditors in the event of the insolvency of an Australian ADI. This legislative provision is referred to as depositor preference." So, Martin, what this is saying is two things. One is that deposits are unsecured creditors, but if a bank was to fail, then the deposits have the preference. So they become the first rank of unsecured creditors that they get paid out first compared to others.
Yeah, so the way it works, if a bank completely collapses and it needs to be effectively unwound, right, then there's a hierarchy of distribution, right? And right at the bottom are shareholders, so they probably won't get much back. But at the top, guess who comes first? The taxman, the liquidators, so they get paid out first. Then secured creditors, so anybody who's got security with the bank gets paid out, right? Then you go into the unsecured level, and what this says, and it's same with the Banking Act earlier on, is that the depositors rank above other unsecured creditors. So you're way down the list, but you're not right at the bottom.
Yeah, yes, but yes, so you're at the top of the list of unsecured creditors, yep. But you are a unsecured creditor.
Absolutely.
Yes,
yep.
yes. Yep. Now, so now that we've established that when you put your money in a bank, you have technically given the bank a loan. Yep. Now, the other part of the title of the show is that you've given a rigged loan. Now, the key point on this one, Martin, is why is the loan rigged? Is because typically when you give someone a loan, you as the lender dictate the terms of how you lend. And obviously, when we go to the bank to get a mortgage or a car finance or a credit card, etc., the banks dictate the conditions of how we will borrow the money from the bank because they're giving us the money.
Yep.
But when we, as the depositor, put our money into the bank, well, the borrower, as in the bank, they dictate the terms and conditions of how this loan arrangement will actually come about, and we as the lender just have to accept that on face value. So now, and obviously that's quite critical when we think about the whole topic of bail-in, when we think about in terms of the cash ban and the freedom from banks. Well, when we think about the $10,000 cash transaction ban, it's in effect the freedom not to loan a bank money because we are unsecured creditor. Now, this is not a point that we've made in that particular debate, but yeah, it's critical that if we don't want to loan the bank money, we don't have to. But then you've got this other complication of, well, when you do loan the bank money, the bank as the borrower dictates the terms of the loan.
Yeah, and let me just sort of make this point. If you were getting an unsecured loan from the bank, right, the interest rate would be 7, 8, 9%, all right? And yet when you get a return on deposit, so when it's round the other way and you're giving your money to the bank, then they pay peanuts. So the whole thing is completely asymmetric.
Of course, yeah. So when you get a personal loan, which is effectively an unsecured loan, those interest rates are much higher than what you would pay for a mortgage. And when we give an unsecured loan to the bank, look, in some cases, exactly, you get peanuts, and sometimes you pay account keeping fees as well.
Yep.
And you basically lose money.
Yep.
Now, the reason why, look, so moving on, Martin, what I think is just critical for the audience to understand is, so when it comes to asset allocation, now, when you hold, for example, physical cash, or you buy gold and silver, or if you bought shares, or if you bought property, or if you've bought bonds, these are, you have purchased some sort of asset, or if you bought cryptos, you have bought something of value. Now, you can question how much value those things have.
Particularly if it's crypto.
Well, potentially. But, crypto's, a whole different conversation.
Yes.
But you actually have bought something where you have ownership rights over.
Yeah.
Now, sometimes people, so for example, if you say to people, show us your assets and show us what you own, well, they would say my deposit in the bank. It's part of my asset. I own it. But technically what you have done is you have given a loan to the bank. So it's a different action of loaning someone money than actually owning something where you have physical ownership rights over. And that, I think, is a critical point that people have to think of when they're allocating assets. Well, do you actually own it, or did you actually lend it to someone?
Yeah, it is more than just an academic discussion here, right? There is a difference. Right?
That's right, absolutely.
Because if you buy stocks and shares, right, you might get dividends, but you actually own a chunk of the company, right?
Correct.
If you are holding a bond, then you've got a promise of a flow and the end of the bond when it's bought back. But with deposits, what you're doing is you're passing money across, you're assuming that the bank will be able to pay you interest if there's interest to be paid, and at some point you can get the money back. But it's a loan.
Yes.
And it's at risk.
True. And Martin, when I had a lot of people who watch this show contact me throughout 2019, and we talked about bail-in and we talked about a range of financial and economic matters, when it came to this particular point, I've asked a lot of people, one, are you aware that you've given the bank a loan? And also, if you don't trust the bank, because obviously with all of this financial risk, the question of do you trust the banking system? Well, if you don't trust the banks to pay back your loan, one of the key options available to you is not to loan the bank money.
Yeah, or you basically say there is this bank deposit scheme, right, which is government backed, 250k if it's activated, right? So a lot of people will say, well, that will give me comfort that even if the bank were to fall over, the government would actually be able to refund us. But as we've proved previously in one of our earlier shows, only if it's activated.
Yes, yeah. Look, and even if it is activated, the government has put no money aside to actually pay the insurance.
Yeah.
So there's a big question as to can the government find the money in the middle of a crisis actually pay the insurance out?
Yeah, and it's capped, of course, both at a total amount for a particular banking license for a particular customer, and it's also capped at a maximum level for each of the institutions.
Correct.
So there are some limits, and so again, it's much less clear than people perhaps would think.
Yeah. Now, Martin, what I want to do with the audience, I want to have a bit of fun. So I want to just build on this whole premise that in terms of when you put your deposit in a bank, you've given a loan. So Martin, I want you and I want the audience to, so we're going to go through a number of scenarios, but I want you to imagine you're down at your local pub, so here in Thirroul, and we're going to have someone come up and have a conversation with you, and his name's Fred. And so Fred's going to come and ask you a question. So let's actually put the question on the screen. So Fred's going to ask you, Martin, quote, I'm a bit short of money and would like to borrow $10,000 from you, but I don't have any assets that I can guarantee against this loan. So he wants to borrow some money, Martin. So obviously what you want to do now is you want to have a bit of think in terms of, someone's just randomly come up to you and says, hey, I want to borrow some money.
Yeah, I mean, do I know Fred? Do I not know Fred? If he's got nothing to back that request, my immediate reaction is, you must be kidding, mate. Why would I give you money, right? If I was really serious about it and thought, well, maybe I can do something here, but I'd want to make sure that there was some risk-reward trade-off, right? And I'd also need to know on what basis I was going to make the loan.
Yes. Okay. So look, all of that seems quite prudent, quite commercially sound, etc. Now, before you make your decision, Fred has a couple of things to say to you. So we're going to put up scenario 1 on the screen. So Fred's going to say to you, Martin, mate, I have an extensive list of rules I'm going to impose on you as part of this commercial agreement. Now, Martin, so remember, you're at a pub, someone says, mate, I need to borrow $10,000 from you, and he says he wants to impose a range of conditions on you as the lender, because that's just what he wants to do. So if someone said this to you in the pub, Martin, what would you say? Boot
on the wrong foot, mate, is what I'd say. If I'm going to lend you money, then I need to determine what the appropriate terms and conditions are, and the base on which I'm going to lend it. Why would you want to tell me what I can do? So Fred, he is the bank. And basically, in this scenario 1, what we are revealing is what happens when you, the depositor, put money in the bank. Fred says to you, I'm going to impose, terms and conditions, an extensive list of terms and conditions on you, and you as the lender just have to accept it.
Now we're going to go to scenario 2, Martin. Now, before you make your decision as to whether you're going to give Fred this money or not, he actually has something else to say to you. So let's actually put this on the screen. So Fred now says this to you. He says, mate, I need to borrow your money, but I must say it takes a lot of effort to receive and handle 10,000 in physical cash notes. It also takes a lot of effort to give you your money back. For the period that I am borrowing your money, I will charge you $5 per month to reflect the effort it takes to handle your cash. Now, again, so you're down at the pub, someone says, hey, I want to borrow 10,000, I'm going to put some rules on you, but he also wants to charge you $5 a month to borrow your money because he says it just takes a lot of effort for him to handle your money. So if Fred said this then to you down at the pub, Martin, what would you say?
Well, again, a bit gobsmacked. Hang on a moment. You want me to give you money and then you're going to charge me for me giving you the money?
Correct.
Right. I better put the interest rate up a bit higher then to cover the costs of it, right? I mean, it's all back to front, isn't it?
Yes. Well, okay. So what happens in this situation? This is a bank account fee. So this is exactly what happens when you put money in the bank. Fred, as in the bank, says that it takes a lot of effort for them to handle your money and they will charge you a fee to handle your money. So we've had some outrageous statements from Fred just asking you for the money. Now, something's come over you, Martin, and you say to yourself, okay, Fred, what the heck? You seem like a nice chap. I'm just going to loan you the money.
Okay, so let's assume that I agree to give Fred the money, right? It's 10,000 now. Do I give it to him in cash? Right? If the cash ban comes in, I can't. I've got to put it through a bank account. That's another sidebar, right? But down the track, I wonder what happens then. So, maybe a few months later, I say to Fred, hey, Fred, I want my money back.
Okay, so, and now when you ask Fred for your money, Fred's going to say the following thing to you, Martin. Mate, I can't give you your money back right now. However, I can give you about $30 a week for the next few weeks until I assess my financial position. So if Fred said this to you, Martin, what would you say?
I wouldn't be very pleased, right? Because I basically wanted the money, needed the money for a particular purpose, and now I can't get it when I want it.
Aha. So what we've just described, Martin, is we've described what happens when you have a capital control. And where do we see capital controls in earnest? In 2012, particularly in Greece, where you could only go to an ATM and get 60 euros a day out of your ATM. So that is the equivalent. When you give someone a loan and says, well, I can't give you money when you want it, I'll only give you a certain amount per day or per week. You would not be happy if Fred said this to you, and yet when people put money in the bank, they just accept that this is a possibility that Fred may say this to them.
Yeah, so I was expecting to get 10,000 back, and instead I get a little drip feed and no real certainty about when precisely I get the whole lot back.
Absolutely. Now, so why don't we just ignore what Fred just said to you? So when you ask for your money, so we're going to go into this next scenario. So Fred says to you this. He says, mate, what I'll do for you is I'll give you 5,300 back in cash, but I'll also give you a stake in a business that I own. So you find out later that the business that Fred owns is in dire financial straits, and you're not sure whether the business can turn around. So he gives you 5,300, he gives you an ownership stake in a business, and you find out that the business is struggling, and you're not sure if the business is actually going to be an ongoing concern. Well, if Fred said that to you, Martin, how would you feel?
Well, let's face it, I gave that money across to Fred on the assumption I was going to get it back when I wanted it, right?
Yep.
I want it back, and he's now unable to give me the whole amount. He gives me a smaller proportion, and then gives me something else instead, right? And that share in the business is of an unknown value, of an unknown risk, and therefore I have been essentially robbed of half my money. Yes.
Now, what we just described is a bail-in of a retail bank deposit account. And so the reason why I picked the 5,300 in this scenario is, well, when Cyprus happened, they confiscated 47% of in terms of deposits above 100,000 euros. So I thought confiscating 47% in this case would be quite apt.
Yeah, and sidebar, they got that bail-in to keep the bank going so that it didn't lose the whole deposit.
Correct. So in this scenario, so Fred says, I'll only give you a portion of your money back and an ownership stake in a dodgy business. You would not be happy. Okay, so now, Martin, imagine Fred didn't say that to you, but Fred said something. He said completely different. So Fred. So when you ask Fred for your money, Fred says the following. It says, "Mate, I got hit with a series of ongoing bills that I didn't expect. So while I have your money, I'm going to reduce how much I owe you by $50 a month until you call in the loan." So if Fred said this to you, Martin, how would you react?
Way. So hang on. So my $10,000 is now being eroded month by month by month by month, the longer that Fred holds it for.
Exactly.
Then I want it back straight away, and that wasn't in the terms and conditions anyway, was it?
Well, I mean, what we've just described is negative nominal interest rates. So that's what happens is you've given the bank a loan, and then when they impose negative interest rates, your capital gets eaten away, which means that the amount of money that they have to pay you back as part of this loan arrangement, it actually decreases over time, and that's what. So, and obviously, what you just said is the natural response. Well, if you're going to reduce the loan balance, I'm going to take my money out now. And this is obviously why the cash ban fight is so important, because we want to have the freedom to escape the system.
Yep, I'd want it back straight away. But then, of course, he'd say he couldn't do it anyway, so we go around in circles, wouldn't we?
Yeah. So, okay, Martin, so just say that Fred doesn't say that, but he says something else to you. So you say, give me my 10,000. So Fred says this. He says, mate, rather than giving you 10,000, I'm only going to give you money that allows you to buy 8,000 worth of goods and services. So now, we're not sure why Fred says this, but if Fred was to say this, Martin, how would you respond to Fred?
Well, hang on a moment. I thought I'd given you $10,000, and that $10,000 would be the equivalent of a certain set of goods and services. What you're now saying is you've basically devalued that to 8,000. So suddenly I'm worth less than I thought it was.
Yes.
Wouldn't be happy.
You would not be happy.
No.
So what we just described as quantitative easing or currency debasement. So basically, when you print money, and it goes back to some of our previous shows, you reduce the value of those physical notes. And again, people, if this happened at a pub, and you asked for your money, and they said, "Well, I'm not going to give you 10,000 back. I'll give you 8,000 back." People would be extremely angry about that. But yet, this is what is happening in Australia, but like it's happening right across the world as well. Now, so we've gone through these scenarios, Martin. Now, you are at this point very upset with Fred, and you don't have much confidence in Fred. Now, in order to calm you down, so that because Fred still needs your money, so in order to calm you down, Fred is going to introduce his friend Sam. Now, so let's go into this in terms of this new scenario. So Fred says to you, so when you ask for your money, Fred says this. He says, mate, I have another mate called Sam who is willing to cover my debt to you if I can't pay it back. So you later discover that Sam doesn't have the money put aside to cover Fred's debts, and that Sam has been racking up huge debts for the last 12 years. So how do you feel about that? So he's trying to calm you down, saying, if you don't trust me, I have a mate called Sam. Sam's going to help me out here, just in case if I can't pay you back. But then you check out Sam, and then you say this, and then you realise that Sam's pretty dodgy himself. So how do you feel about this new arrangement, Martin?
Well, I should think it'd be pretty worthless, wouldn't it? Because unless Sam has actually got assets behind him and actually can deliver on the promise, it's meaningless.
So what we just described is the Australian government's financial claim schemes, i.e. deposit insurance. So the government has not put any money aside to pay the insurance, and for the last 12 years since the end of the Howard government has been raking up huge debts, and yet so you would not feel confident about doing business with Fred, even though he says he's got his mate Sam. So you wouldn't be confident about Fred or Sam, and yet there's a lot of Australians who are confident about this deposit insurance scheme.
Yeah, and of course it's capped at a certain level, and as we said before, there are limits attached to it and uncertainties attached to it. So it's by no means a clearer guarantee, and it has to be activated.
Exactly. Now, coming to the end of this role play, Martin, is the key question comes is, well, if any Australian was at any club, bar, whatever party, and Fred came up to them and said any of these things, people would say, you're out of your mind. I'm not going to do business with you, Fred. I don't care if you have your mate Sam, whatever. So the question then becomes is, well, why do Australians give banks loans under these sort of conditions?
Yeah, and I think it's a really long and complicated question, right? And it's partly because it's always been that way. It's partly because the banks are still perceived to be as secure, safe, etc., etc. And I think the fundamental point is people don't get that they're making this unsecured loan. That's not what they're thinking. It's like I said earlier on. It's back to the urban myth that the bank is just looking after their money until they want it back.
What I'll say is to the audience is, without going into a lot of detail, when I think about me being at a bar or a club or something and me being approached by Fred, I personally would not trust Fred. I would be quite outraged if Fred asked me for money and then said any of these things to me. And because this is a reflection of our banking system, I mean, what I have done, and when we look at all the risks and we declared that Armageddon started with the repo crisis last week, etc. Because I know if I put money in the bank, I have given a loan. That's why I've taken the bulk of my savings out of the banking system, because I don't want to give Fred a loan. Now, having said that, do I still use the banking system? I do. Do I have a credit card to pay bills? Yes. So I do use the banking system, but knowing that if I put my life savings in the bank, I'm giving that bank a loan, and that the bank would be saying one or multiple of these statements to me. That's why I said, well, it doesn't make sense to me to do business with Fred, because if this was down at the pub, I'd tell Fred to basically piss off.
Yeah, and you and I have a different view, right? So I've still got money in the banking system, right? And the reason I've got it is because the other alternatives, be it stocks, be it metals, or even crypto, all have risks attached to them as well. It's not like one set of risks, one's another set not risks. My argument is that, yeah, there are some risks attached to deposits, but, you've got to weigh those risks up against the other ones. And I've, at the moment, weighed them up, that I don't think the risks are as extreme as you see them, but I do understand the limitations of deposits, and I do understand that it is a loan to the bank.
So yes. So to sum up this conversation, I see that there are alternatives out there that are less riskier than Fred, and you still trust Fred.
Yep. Relative to some of the other things that are available.
I think Fred's quite dodgy, and it's sort of extraordinary that you still trust Fred relative to some of those other options. But I guess without, given that we can't provide financial advice, it's up to the audience as to whether they trust Fred or Sam or not.
What we can say, John, is read your terms and conditions, right? If you're going to put money in the bank, and understand that there are some risks attached. So deposits are not risk-free, right? And then it's a trade-off between deposits versus other asset classes.
That's
right. The bottom line is, wherever you look, there are risks.
Mm-hmm.
And that's probably the most important takeout from here. Martin North, John Adams, in the interest of people, we'll see you next time.